Russia's finance ministry tried to sell government bonds this month. Nobody bought them, not one. At the same time, in a handful of oil fields in Tatarstan, workers are quietly shutting down wells nobody wants the oil from anymore. Today's video is about the economic story underneath the war, the one that doesn't show up in frontline maps or drone footage. We'll look at what's actually happening in Russia's stock market, why a small, unglamorous oil region in Tatarstan might be the clearest signal of where this is heading. And we'll touch on the political storm in Kyiv, because it's happening at the exact same moment for a reason. Welcome back. Let's start with the number that's hardest to spin. The Moscow exchange has now posted losses for roughly 17 straight weeks, independently confirmed by multiple financial outlets as the longest unbroken losing streak since 1997. That date matters. 1997 was the prelude to Russia's 1998 default, when the ruble collapsed and the state itself ran out of money. The index is now back down near the lows it hit on the day Russia invaded Ukraine in February 2022, erasing most of what the market gained in the years since. One analyst summed up the mood on trading floors bluntly: the scale of the sell-off no longer looks like a routine correction. It looks like investors repricing Russian assets from scratch, and the timing is almost absurd, because this is happening while global oil prices have actually been climbing, thanks to renewed tension around the Strait of Hormuz. The kind of price spike that in any previous year of this war would have sent Russian energy stocks higher, not lower. Now to Tatarstan, because this is the part of the story that doesn't make headlines, but arguably matters more. Tatarstan isn't one of Russia's giant Siberian oil provinces. Its wells are old, mostly what the industry calls stripper wells, producing around a single ton of oil a day each, requiring constant pumping, water injection, and maintenance just to keep running. Individually, none of them matter. Collectively, small operators in Tatarstan account for roughly a fifth of the region's output and a meaningful slice of Russia's independent oil production overall. Here's why they're shutting down. Refineries across Russia have been hit repeatedly by long-range drone strikes, and many are operating at reduced capacity or not at all. Reports citing industry sources describe refineries simply refusing new crude storage terminals already full, and export routes constrained. So the oil gets pumped and then has nowhere to go. Meanwhile, Russian tax law still requires producers to pay the mineral extraction tax the moment oil comes out of the ground, regardless of whether it's actually been sold yet. Industry accounts describe the tax alone consuming up to 80% of a small producer's revenue when the oil can't move. Payroll and taxes still come due either way. At some point, the only economically rational choice left is to stop pumping oil you cannot sell and cannot afford to store. It's worth being precise about scale here, because it changed quickly. A few weeks ago, reports put the number of shut-in wells in Tatarstan in the low hundreds, a figure small enough to plausibly be normal industry fluctuation across a region with well over 100,000 wells nationwide. The more recent figure being reported is in the thousands, concentrated specifically in this one region. That jump from hundreds to thousands in a matter of weeks is what turns a routine statistic into a genuine warning sign. That's a different kind of damage than a bombed refinery. A shut-in well, especially an aging one, is often difficult or impossible to bring back into production later. Reopening it can require investment and equipment that, under current sanctions, simply isn't available. Reports describing the situation call this a domino effect. Refinery damage is now working backward through the entire supply chain, all the way to the wellhead, and once wells go quiet in the permafrost regions, they may not restart even after the war ends. Now back to the financial markets, because Tatarstan and the stock crash are the same story from two different angles. Russia's finance ministry needs to borrow heavily to cover a war-driven budget deficit that could reach several trillion rubles by year's end. On July 1st, an auction for government bonds sold only a small fraction of what was offered, despite yields near 15%. On July 15th, the ministry tried something different: floating rate bonds instead of fixed ones, designed specifically to shift risk away from buyers and make the debt more attractive. The result, according to the ministry's own statement, was that no bids reached an acceptable price level at all. Zero. Compare that to a bond auction the previous November that was more than twice oversubscribed. In 8 months, Russian investors went from competing to lend the state money to refusing outright. And it's not just bonds. Russians have been pulling cash out of banks in large volumes over recent weeks, according to central bank data reported by financial outlets, a shift driven partly by fear that private savings could eventually be redirected into state investment schemes. There is, in fact, a real proposal reportedly being prepared to automatically move billions of dollars in dormant pension accounts into state-directed funds without account holders' consent. When people start treating their own bank as a bigger risk than holding cash, that's not a market correction anymore. That's a trust problem, and trust is exactly the thing a war economy running on subsidized lending cannot function without. A European intelligence assessment reviewed by Reuters put the underlying dynamic plainly. Russian banks are currently propping up the war economy by flooding it with subsidized lending, creating what the assessment called an illusion. One that's currently masking, in its words, an explosive situation building underneath. That's not commentary from a Ukrainian official or a Western pundit. It's an intelligence assessment describing the mechanics of how a wartime economy can look stable on paper, while the institutions underneath it quietly run out of room to maneuver. There's a reason all of this is happening at the same moment as a political crisis in Kyiv. Ukraine's popular defense minister, Mikhailo Fedorov, was dismissed this month after a prolonged dispute with the armed forces commander-in-chief, triggering large protests in Kyiv, Lviv, Odessa, and Dnipro. It's a genuine political test for Zelensky, and it deserves its own analysis. But it's worth noting the contrast. Ukraine's crisis is a public argument over reform and strategy, playing out with protests, press conferences, and open criticism from the minister himself. Russia's crisis is playing out in bond auctions. Nobody attends an oil wells being quietly capped in a region most people have never heard of. A system with no mechanism for public disagreement, just numbers that keep sliding whether anyone is allowed to talk about it or not. That contrast is the whole point. One country's institutions are visibly straining under democratic pressure and correcting course in public. The others are failing quietly. One unsold bond and one capped well at a time, behind a media environment built specifically to prevent anyone from asking why. The wells in Tatarstan are shutting down one by one. The bond auctions keep coming back empty, and the illusion the intelligence report described, the one built on subsidized loans and silence, is getting harder to maintain every single week this streak continues. No press conference in Moscow can talk a shut-in well back into production, and no denial can fill an empty bond auction.